announcement. And let's get started. A warm welcome and a good morning and good afternoon and good evening from wherever you are dialing in from. By way of introduction, my name is Deborah Keller and I lead on the Impact for Breakfast initiative. This initiative is supported by Artha Impact, which is the impact investing arm of the Rianta Capital Family Office. This specialized group has been gathering and growing since 2008, starting in London, our very first chapter, with an expansion today to 32 cities and chapters around the globe. Our informal network counts 3,300 members who are meeting virtually, like this one, and in person in their local chapters to discuss challenges, models, methodologies, case studies, anything that can help us better navigate and understand the space between social and financial return. Our objective with our informal gatherings is to help build relationships and learnings that drive action and ultimately capital into this sector. Our events and sessions are led by sector experts and are a safe space for brainstorming and deconstructing the most challenging questions we face in the impact space. Impact for Breakfast is an informal network of family offices, foundations, funds, venture philanthropy, and intermediary organizations with a common focus on social enterprise, entrepreneurship, and impact investing. Those who are new here and are joining us for the first time and you wish to learn more about our network, you're welcome to visit impactforbreakfast.com, where I will share the link shortly in the chat field. Climate tech is an investing theme which is rapidly moving into the mainstream, but it is still a highly dynamic and emerging space. Today, we will learn how investors navigate this area and begin to allocate capital to innovation that is profitably delivering real climate solutions. I have the pleasure to have with me today two amazing experts in this sector that will lead on the discussion today. With me in the room today, Bella Hanratty. Bella is the founder and partner of Kneeling Capital, and Ross Maiden. Ross is the director of Kneeling Investment Committee and leads the climate tech and sustainable private investment strategy of a large UK family office. Before we get started, I want to inform you that this session is being recorded for those who just joined us a few minutes ago. We will share the link with you in a follow-up note, which you're welcome to pass along to your network and colleagues, to anyone in your crowd that should know about the content that has been shared or will be shared today. During the presentation, please ask you to mute yourself. We will have some time for a Q&A round after the presentation where you can ask your questions, unmute yourself and share your thoughts. If you have a question during the presentation, you're also welcome to put it in the chat field, and we'll make sure to pick it up and share it with our speakers so they can answer it. That's it from my side. And now with no further ado, over to you, Bella and Ross. Look forward to your presentation.
Thanks, Deborah. But thank you so much. And thank you everyone for joining. And Christine, I think you deserve an extra thanks for being up at 5 a.m. in Canada. So you definitely win the prize for most committed here. I'll just share my screen and move over to the presentation now. So I'll just briefly introduce us so you know who you're talking to and maybe why you should listen to anything that we have to say. So Keeling Capital is us, and we're named after the Keeling curve, which is the plot of atmospheric CO2 concentrations. So this one sort of going up and to the right in the jigsaw line up to about 420 parts per million. And climate is right at the heart of what we do. The first thing that we're doing is building a climate venture fund of funds to give investors the on-ramp to come into this space. That's really a function of the market structure at the moment, where you have a lot of interest allocated into climate and climate tech, but this space is still emerging, highly dynamic, and identifying and then vetting the right managers that have the right skill sets and building a diversified portfolio is actually quite challenging. So we're raising $100 million this. We're going to do our first close over the summer. We'll make about 15 fund investments over time. So giving our investors about 250 to 300 underlying portfolio companies. I would say this education and community bit is so much at the heart of what we're doing. We understand that this space is an area for passion of many people, and it's more than just an investment where it gets put in your bottom drawer, and people want to know their risk-adjusted returns and Sharpe ratio at the end of the year. So we have a lot of people who are both investing their money, but also transitioning their career and their professional time into climate. And I know that the group we're speaking to here, there's already people on different parts of that transition. Briefly on myself, my sort of the guts of my corporate career was at UBS, the investment bank. I left there 6 years ago to start down this path, and really, it's a similar thing, aligning my professional time and energy with an outcome that I cared about. And through a process of iteration, have kind of gotten to this point and this model. Ross, I'll do your intro in the interest of time. Ross and I are actually best friends from school, so we've known each other for a little bit north of 20 years now. As Deborah said, Ross has been running the climate impact private market strategy for a large UK family office, and has basically built this exact product in-house for them over the last couple of years. So we were sitting on a ski lift a little bit more than a year ago, and I got my hook in and got Ross to sit on my IC initially, but we've been working hand in glove on this. And then finally, Tony, who you'll see here is our resident, well, it's black and white, but he's a resident grey hair. He's been around for about 30 years in this space. So really a pioneer in the field, has seen multiple market cycles and technology cycles, and has invested in all sorts of things from concentrated solar to developers and hydro and geothermal and biofuels. So he's an unbelievable source of information, and he spends a lot of his time in the nature-based landscape at the moment. So just very briefly, I'll so you know who we're talking to, and then let's get into it. So maybe just I'll start with a very short definition to kind of put the context around this. I'll kind of skip over some of this introductory stuff quite quickly, because I know this group is somewhat pre-educated. When we talk about climate, mostly what we're talking about is mitigation, which is reducing the ultimate amount of greenhouse gases that get into the atmosphere, ultimately drawing those down over time, and adaptation, which is how do we evolve our social and economic systems in a way where the impacts of climate change that we are going to have aren't excessively damaging. However, it also touches on adjacent environmental sustainability themes, or if you think about planetary boundaries. Mark, you mentioned biodiversity, that's definitely in there. We would love this to be a broader, more investable category. We won't go into that much in this presentation, because really what we're focusing is on the climate tech angle. But I'll touch on it a little bit. And then obviously things like water, which is actually linked with emissions because it actually has a surprisingly high energy input, particularly in places which are water stressed, like California, which uses about 10% of its electricity moving water from the north of the state to the south, and circularity, et cetera. But most of what we're talking about and what we're invested in is around mitigation and adaptation. And even between the two of those, the vast majority is actually in mitigation. So i.e. decarbonization. Again, this will be familiar to most of you, but just to illustrate that, climate change has kind of been urgent for a few decades. Really, we should have gotten going this in earnest many years ago, but really, 2019 through 2021, net zero became a thing which went from the margins to covering almost all of global emissions at a national level. And then, of course, we've seen public policy and incentives really swing behind this. In the US, sort of most visibly from last year, also the EU Green Deal, and more recently Net Zero Industry Act. And China obviously gets left out of the dialogue a lot because of where we sit, but actually they're responsible for half of all the global investments in clean energy. So they totally dwarf all other countries and even regions. So it's long been a sort of geopolitical and domestic issue then. Maybe Ross, at this point, I'll hand the conch to you if you want to grab the next few slides.
Yeah, sure. Thanks, Bella, and thanks everyone for dialing in and giving us your precious time. We really do appreciate it. So I think one of the reasons that we're very, very excited about this space is when you look at the talent and human capital that's flowing into it. So again, Mark, I think you touched on it at the start, but I think individuals are recognizing the kind of urgency and scale of this climate crisis, and now are starting to dedicate their time and energy to it. It's simply accelerating. So anecdotally, when we speak to GPs and investors, we're hearing the same stories. The quality and the quantity of high caliber talent that's flowing into this space is just unprecedented. This, from what we can tell, is somewhat driven from the cohorts of individuals that are kind of spinning out of very successful scaled up hard tech companies. So, it's very frequently that we see, this new company has been started by the ex-head of, batteries, or the ex-head of engineering or whatever of Tesla or SpaceX or Sunrun or something along those lines, where they've seen this success over the past decade and they've spotted the opportunity and want to actually do something themselves. Alongside this, there's been a number of different platforms that have come out and initiatives. So obviously Impact for Breakfast is one that's kind of getting the conversation going. There's another handful of folks out there, such as My Climate Journey, Climate Base, Climate Draft, and TerraDo. All of these are providing education and different platforms for people to meet, discuss ideas, and essentially just kind of learn along the way. So this is, again, accelerating the number of kind of eyes on this problem. If we look at the chart on the right-hand side that we have on screen, so that's focusing on the number of venture capital deals by stage. Just, very kind of crudely, the very bottom kind of darkest green bar is seed stage companies. As we can see, the number of those companies that are being founded and funded over the past number of years is just accelerating. And then I guess finally on the kind of talent piece, I had a look at the Y Combinator website, which I'm sure you're all familiar with. You can look at the directory of companies. And when you search climate, there's about 150 different companies that come up. Of those 150, about 85 of those have been founded in the last 2 years. And then more specifically, they actually put out essentially a call to action at the end of last year saying, this is an area of interest for us. We want more and more founders to come. So I think they're recognizing, the commercial opportunity, but also the kind of urgency that's needed in this sector. If you go to the next slide, please, Bella. So alongside human capital and talent, just obviously understanding what's happening in the capital markets and the kind of broader investment markets, they're just starting very kind of zoomed out. This chart here looks at the total investments in 2022 across the entire space. The bar on the left-hand side, the biggest bar, for the first time ever, we've seen this actually go over $1 trillion. So this is the investment in the energy transition. It's largely made up of renewables and electrified transport, so the yellow and the green bars, but a significant amount of capital, and I think a jump from about $850 billion, sorry, from the year before. The bar on the right-hand side, so the climate tech and corporate finance is where we're going to focus in on. So the blue piece of that is around a $70 billion piece of the pie. And that focuses on venture capital and private equity. Next slide, please, Bella.
Ross, I don't know if anyone else can. Your audio is a little bit glitchy. Maybe if you want to clear your video.
Yeah, sorry. Let me do that. Okay, hopefully this will be a little bit better. So if we kind of drill into a little bit into the venture space, just to get a bit of an understanding as to what's happening there. top chart here is looking at climate tech venture on a global basis annually. As we can see from kind of early 2018-19, there's been a bit of a ramp up into 2022. The forecast is between 22 and 23, there's going to be a significant drop off. However, looking at the bottom chart, which is expressing climate tech versus the broader tech market as a percentage, we can see that 1 in every $5 is still going into the climate tech space, you know, highlighting the significance of this actual space and the growth of it versus the broader tech. The drop off is doesn't need much explanation, but it is clearly driven by what we're seeing in macro and in the macro markets. Bella, if you could hit the next slide, please. So again, drilling in even deeper again. So this is looking at climate tech venture on a sector by sector basis. And so the top chart is the difference between 2021 and 2022. It's measuring deal count per sector. As we can see across the entire space, all subsectors are actually growing on a deal count basis, suggesting that there's a kind of broadening set of opportunity. If we look at the lower chart, the kind of interesting thing to note here is the kind of primary two spaces that had made up the climate tech venture market before, which is transport and food and land use, were actually down on a dollar basis. However, some of the kind of more nascent spaces, such as carbon management, built environment, and so on, have seen significant dollars flowing into those spaces. So just essentially what we're seeing is this kind of broader set of opportunities and a more distributed dollars across the space. So I think, I mean, just kind of taking all those points in summary, and I hope you can still hear me well, but taking all those points in summary, what we're seeing is this kind of confluence of positive factors come together. We're seeing corporate demand on the net zero side. We're seeing very strong government policy supporting it. We're seeing a lot of high quality talent recognizing the scale and urgency of the problem and coming in to form companies. And then lastly, we're seeing the capital markets respond to this and actually injecting a significant amount of capital. So as these four pillars come together, it creates a very interesting and significant investable opportunity set. I think with that, I will pass it back to Bela to take it from here.
Thanks, Ross. So we're going to sort of switch gears a little bit here, and the next few slides, we're just going to talk about what the main decarbonisation pathways are, and particularly with a venture hat on. Not all good climate solutions are good tech plays, and I know Mark, for example, we touched on biodiversity a little bit before. I'll sort of illustrate a little bit why this is less front and center for us. And I also know a few of you in the chat working in emerging markets, where the deployment opportunity is amazing. It's not core to what we do because of just where the deep venture markets are, but just because we don't talk about a topic here doesn't mean it's not important or that there aren't good things to do there. We're just really speaking about things particularly in our wheelhouse. But in this next section, what I'm going to try and do is give a little bit of a framework for thinking about decarbonisation, which is cross-sectoral. And if anyone's interested in delving into these further, I've written a series of blog posts, about 14,000 words end to end. So hopefully some of a reference piece, but also quite a lot of graphs, sort of unpicking these further. So we can give you details about that at the end. So this is the, what probably be familiar to a lot of you. This is where our emissions come from. As you can see, the vast majority of it is in energy. And what we think of as typically as the energy system, but also end uses in industry and transport, etc. The one big exception is ag and land use, but you can actually see that the sources of these emissions in ag are not as tractable with technology. A lot of it is not the physical infrastructure, but is actually a lot more to do with farming practices and land management and things like this. So you can see like rice cultivation, crop burning, livestock manure. You know, there are certain applications around this. I mean, there's a few different companies doing livestock feed additive, which reduce methane production. And there's, you know, seed genomics, there's soil analysis for carbon content and other things. But overall in our portfolio, this will be relatively underrepresented compared to its slice of the emissions pie. So really when we're talking about climate tech, we're mostly talking about energy, and energy transition and climate transition are somewhat synonymous, at least on the decarbonization side. Obviously, adaptation and adjacent things like biodiversity are a little bit different, but they're not always necessarily tech plays. So if we think about energy transition, then maybe a working definition is supplying the energy we need to fulfill society's needs while reducing the amount of greenhouse gases that go into the atmosphere. And this bit about supplying the energy that we need is frankly often overlooked or diminished by a lot of the narrative around climate and the climate community. At the moment, this is predominantly fossil fuels, oil, gas, and coal. And obviously, we've already seen in Europe the consequences of an energy crunch. If anyone reads The Economist, the section in Numbers last week suggested that there's about I think something like 70,000 excess deaths in Europe because of energy poverty. Last year due to higher natural gas prices and energy prices. So it's a real thing, and we I'd say would be less anti-fossil fuel than most people spending all their time in climate. We're very much focused on building new solutions and not turning off the things we need to run our society in the meantime. And there are a few main levers for getting us there. And by the way, this is, if we want to get into a bit more of a nerdy conversation, this is primary energy in terawatt hours. Ultimately, what we're interested in is actually useful energy. So it's not the chemical content of the fossil fuels, but actually the work, so the kinetic energy for transport or whatever else that we want at the end of it. So it's not as challenging as this would appear, but it gives you a sense of the order of magnitude. So the four main decarbonization vectors, and these are roughly in order of priority, but they all kind of need to happen together. First of all, it's reducing demand for fossil fuels through energy efficiency and electrification, which kind of go hand in hand, in fact. Then it's increasing supply of low carbon electricity and also heat. Then green molecules for things particularly where molecules have an intrinsic value. So really we're talking about plastics and chemicals, fertilizer, et cetera. And then secondarily, where we need liquid fuels for energy density, particularly things like aviation would stand out there. And finally, carbon management. This is point source carbon capture from concentrated gases or exhaust gases. So this is maybe power plants, but certainly ethanol facilities and cement and so we'll get into some of these. And sorry, the other thing, carbon management is removal. So taking CO2 out of the atmosphere and greenhouse gas out of the atmosphere, or preventing them from getting there in the first place through methane management as well. So yeah, I'll skip over these and give a few examples. Yeah, we have about 10 minutes now, and we want to leave plenty of time for questions because we know this is a pre-educated, largely unmotivated audience. So, we're also super excited to hear the things that you want to get into in your perspectives. So energy efficiency and electrification. For anyone who's eagle-eye, you might notice these numbers aren't exactly the same as Bloomberg New Energy Finance, but if we just kind of look at the trends, this is numbers from the International Energy Agency. We see a solid increase in funding or investment in energy efficiency and electrification, something to the tune of they say about 575 billion at the moment, which under their kind of business as usual scenario will take up to something like 850 billion in the second half of this decade, with their net zero scenario being something like 1.5 trillion across electrified transport, buildings, and efficiency, mostly in those. Frankly, the IEA has an almost laughable record of underestimating the rate at which clean energy will be adopted. Some of you might have seen the plot of their solar forecast versus reality over time. So particularly with the adoption of EVs, but also a lot of new manufacturing capacity coming online for solar. Those numbers that Ross showed a little bit earlier from Bloomberg New Energy Finance, we'd actually expect those to go up a lot in the next couple of years. We're really we're on an exponential growth curve. So we would assume this would be in the order of trillions a year fairly soon. I've put some examples of companies down the bottom and trying to give a sense of the breadth of innovation. After this, I'm happy to provide the presentation to anyone who wants it. We'll leave our contact details at the end, and Deborah will also have it. But at the bottom we have companies that are working on home electrification, on more energy efficient cooling, on building design, on industrial separations, so using membranes rather than heat, electrified heat in the case of electrified thermal solutions. One company here which is actually going to be one of our underlying portfolio companies, MineSense, they're involved in making mining more efficient. So effectively sensors that go on the top of mining shovels that will in real time determine the quality of the rock or ore that's going into the bucket and say, okay, do we actually bring this for processing or does it get dumped as waste? Since we use 3% of the world's electricity in crushing rocks, this is both a huge energy saving, but also represents a key part of the supply chain for energy transition, because copper goes into a lot of things that we're going to need, and it's structurally undersupplied for the moment. So that's kind of a nice example where you have it's both an enabling tech for the transition as well as being an inherent energy efficiency play in itself. Decarbonizing electricity. So in some ways, this is it could be the killer app. If we had sufficient low carbon electricity and it was cheap enough, and we could kind of do whatever we wanted. We could pull CO2 out of the atmosphere. We could then split water into hydrogen, and we could combine them, and we could make zero carbon liquid fuels and reuse all of our infrastructure and remediate lots of other environmental things. We could, deacidify the ocean, whatever we can get onto later. But the first protocol is just decarbonizing electricity supply for existing demand. Obviously, that's going to go up a lot with electrification of transport and heat, which we just touched on. We kind of think of this in two buckets. Well, yeah, sorry, I see I have the Brazil chart up here. I was actually just giving this presentation to Brazilian business owners yesterday, but it's worth pointing out that the only major electricity grids, and Christine, this is one for you, Canada is relatively one of them, are where they have hydropower and nuclear are the only two technologies which have actually managed to decarbonize substantially large grids. Smaller grids like Iceland are low carbon with geothermal, but that's a pretty niche application. So we definitely see more of a role for nuclear in particular, and we can get into that. But we kind of think about decarbon electricity and actually a lot of climate tech in two buckets, which is basically new stuff. So kind of more more deep tech, even though deep tech is across both of them, and then technologies which enable the further rollout and greater penetration of mature technologies, basically wind, solar, EV batteries, etc. So I split these logos accordingly at the bottom. So on the left here, we have a couple of companies, top GA Drilling and Quaise, that are looking at doing super deep geothermal. So getting to very high temperatures, which much higher efficiency of conversion of heat to electricity. They're both developing new ways of drilling. The challenge is using existing kit is that it melts at these temperatures. So they're using things like millimeter wave drilling or plasma drills to basically vaporize rock. Where you don't have a mechanical drill bit that's gonna fail at those levels. Those are quite exciting, but like a little bit early. GA Drilling actually, they just moved their headquarters to Houston and have just started a test well in the field. Some of these other ones down below you might recognize. TerraPower is Bill Gates's nuclear company that are now working with PacifiCore on actually getting together an order for numerous reactors, which is kind of like Keith getting this stuff rolled out. Helion was in the news recently. That's a nuclear fusion company that just signed the first PPA, power purchase agreement for power, which was signed by Microsoft and some others. They said they're aiming for 2028, which seems wildly ambitious. I wouldn't expect it would be online there, but fusion's definitely worth working on anyway for our longer term ambitions as a society. And then on the right, we have various companies that are basically expanding the ability for renewables to be rolled out, and that could be taking out soft costs like PBCase, which is for solar designers, or Line Vision, which does analytics on the existing grid, which allows us to get more transmission out of the existing infrastructure. Supernode's an Irish company, actually, it's doing that is deep tech, but they're doing superconductor wires for transmission. So there are literally hundreds of companies in this space, probably thousands at this point. So this is just a tiny smattering, but I'm just hoping to sort of give a little bit of a sense of the diversity of innovation going on here. Ross, also feel free to jump in at any point if there's anything particular you want to put in with at any point.
I think just to note, Ben, we've got probably a couple of minutes left before we should hit Q&A.
Yeah, I'll rattle through. So green molecules, as I said at the top, what we should prioritize in molecules is where the value is in the molecule rather than in the energy. So what we have seen is the practical role of hydrogen has been retreating over time. Initially, maybe you've seen in the UK, it was in the hydrogen strategy that it might be used in home heating, which is a crazy waste of a potentially valuable molecule. So decarbonizing chemicals, particularly if you think about like ammonia, super important. This graph at the top is from Michael Liebreich, where he's basically prioritized use of low carbon hydrogen, and most of that is for existing uses. So hydrogen today is a one gigaton problem. So we have very large markets to go after even before we start using it for other things. But there will be certain use cases like aviation, as I said, where the energy density is kind of really a sticking point for electrification. And then last, and one might say least, but actually is still a huge part of the picture, is carbon management. So I said this is both like all of methane management from oil and gas. So something like Project Canary. Methane is about 20% of the overall greenhouse gas emissions. And they've been rising from energy production. So it's almost as much now as from food and ag. Then carbon capture, so point source capture like Svante or Lilac is working on new cement kilns that make it easier to capture process emissions. And then carbon removal. So Ed Carbon is another one of our underlying portfolio companies, or will be shortly, which is doing ocean-based carbon removal, enhancing the ocean's natural ability to draw down carbon. And maybe just briefly on the nature-based side, I said sort of there are some tech opportunities, and certainly the data and trust element around carbon offsets and forestry projects is a big missing thing, or a rate inhibitor for that. So B0 is another company working in that space, and I know we have at least one investor in B0 on the call as well. So happy to give them a shout out. So yeah, I did rattle through that a little bit. There's a lot of content, and as I said, I've expanded on these a lot in a few pieces that I published, and the link is there. Obviously, feel free to reach out to us if you have any questions on this that we don't cover in the next 20 minutes or so. But thank you for your attention thus far, and really looking forward to your questions and talking about the things that are most interesting to you.
Thank you so much, Bella and Ross. It was an extremely insightful presentation, and I know the time was really short, but we definitely want to have time for questions. But again, I'll be sharing that presentation, and I'll be sharing Ross and Bella's contact details. So please don't hesitate to reach out to them so you can continue the conversation in case we don't answer all the questions today. So let's move on to Q&A. If you can't unmute yourself and ask your question directly to Ross and Bella, you can also type it in the chat field and I will pick it up. But if you are free to speak, please do. I'd love to hear your thoughts, your comments, and just unmute yourself and go ahead.
Frederick speaking. Quick but maybe complex questions. Would you say that the two main problems or challenges for startup or young companies in climate tech is both the hard tech issue and the compliance or the political issues? And if you agree with that, as I think you do, then how do you evaluate then projects in those two metrics, or how do you balance those? Like, for example, something that is very challenging technologically, but would be easy to adopt versus something that is, on the contrary, more established, but there's a lot of status quos against it and etc. Those kind of problems.
That's a great question, and it's something that we think about a lot. And I think you kind of alluded to the answer there as well, where a lot of the time, hard tech and climate tech, which is deemed riskier than software, actually just kind of has a different set of risks. So when you're dealing with commodity markets, we use sort of roughly 100 million tons of hydrogen a year. If you can produce hydrogen at a certain price point, delivered, and it's going to be low carbon, there's no challenge in selling it. Same if you're doing cement or steel or whatever else. In many cases, even if you can't deliver the same price, there are sufficient off-takers, because for end customers, these are very small line items in their overall costing. So if BMW pays twice as much for steel in its cars, that doesn't actually move the needle that much for the end price. So that's an extreme example. Obviously, we prefer to not see green premiums where possible, but just to flag that demand for low carbon products is such that there is an on-ramp for some of these things and that. In terms of the political thing, permitting is, I would say, the biggest obstacle or rate limiting factor for this rolling out the infrastructure. So that is a big challenge. I mentioned that company GA Drilling moved their headquarters to Houston. I know a number of companies that have moved their headquarters to Houston because it's relatively easy to get stuff done in Texas. This is it's a big challenge all over the US. Transmission is sort of a glaring a glaring example of this. It's also a big issue in Europe and is stymieing various efforts to decarbonize the grid. So that is that's definitely a big challenge. And it's also opportunity. So, you know, in the US in particular, there's a lot of incentives around this stuff through the through IRA now. So understanding the local context is super important. On the, or maybe a related thing, this isn't, you didn't ask this directly, but people often talk about the capital intensity of some of these businesses. Capital intensity is not necessarily an issue in and of itself, because there's actually no shortage of capital in this world. And particularly at the later stage and growth and infrastructure side, there are, you know, hundreds of billions of dollars waiting to get put into this thing. And the challenge is understanding how you go from the venture bucket into the infrastructure bucket without having to raise huge equity rounds along the way. So what is your scaling journey? At what point can you start using non-dilutive capital, so project finance? And then, you know, effectively, you know, a lot of the time acquisition is going to be a better exit, because that way you can get absorbed into a, you know, Baker Hughes or you know, a Halliburton, whatever else it might be, that have a huge amount of infrastructure that lets us get rolled out on balance sheet. So there are particular nuances to this, but I would say it's a different set of challenges rather than necessarily more difficult than software. You know, and the other thing is, you know, people always say software is capital light, but if you look at a lot of the big software businesses, you know, Uber raised a lot of cash over time. You know, even if gross margins are pretty good, and the cost of consumer acquisition in those businesses can be pretty high as well. So yeah, it's definitely, it's a different set of challenges, and they are real, but not insurmountable.
I might just add as well, I mean, like, there's kind of an expression that hardware is hard, and it is. I've been the CFO of a hardware business and I've seen it firsthand, but this is ultimately a molecules issue that we need to solve, and so we need hardware. The other piece I'd add is on the kind of compliance side, and Bela touched on it, but there's a lot of tailwinds in terms of the IRA and other policies that have come to place. One thing that we're, you know, really kind of cognizant of and spend time on is ensuring that when managers are underwriting businesses, they're doing so not reliant on subsidies or not reliant on these policies. They have to be a business that has a pathway to a standalone business in its own right, and ultimately get rid of this green premium pretty quickly.
Thank you for the answer. That was very useful. Yes, because, sorry, a subsequent question, because this is one of the things, for example, I've seen in, I'm based in France, so I'll speak to that. But for example, when it comes to solar panels for individuals, they're basically still not really very competitive unless you basically have subsidies. And even then, for example, my parents are in their mid-70s and they've declined to put solar panels on their house because it will take too long to amortize the investment.
Mm. Yeah, I mean, there are some new business models that are coming out around financing. So they're helping to kind of solve that challenge. I don't know the French market specifically, but I know in Germany, for example, there's a big residential solar business that has done extremely well. And they're essentially changing that business model and trying to make the accessibility easier for people and just make that a no-brainer. But there are obviously specific country-specific challenges.
Mm-hmm.
But we need this kind of talent that we talked about to come out and have innovative business models to solve that.
Yeah, and that is more of a sort of software business model type challenge. So yeah, again, I think this is probably a bit more visible in the US, but there's a number of companies like you know, Seal, Lunar Energy, Span, etc., that are, you know, in some cases building some hardware solutions, but they're also trying to smooth the customer journey. Because I mean, I have a gas boiler in my house, because when I was renovating, yes, I know, shocking. But when I was renovating my house, you know, I didn't have a spare 10 grand to put into a heat pump, and my plumber wasn't familiar with it, so he was just kind of like, this is what we're going with. So you know, we sort of ended up in that groove. So there's a number of companies now doing this, trying to kind of layer in the various services, and you know, both from a user journey perspective and also the financing, as Ross said. So there's a lot to be done around just taking a soft cost, whether that's for commercial and industrial or for residential, and making it easy for people to adopt a lot of these technologies.
Maybe the final thing I'll say on that, and this is something kind of Bela says frequently when we're in conversations, but we've only really just started trying to solve these problems. I mean, some of these technologies have obviously been around for a long time, but when you look at the charts that we displayed around the financing and capital markets and talent, when these kind of people have started to try and create companies, I mean, we're still super early in this journey. So I suspect if we had this call in a year's time or in 2 years' time, the answer to that question would be very, very different.
Mark G, I see you have your hand raised.
Just a quick one. Was interested to get your views on, and potentially it's your investment thesis, but this idea of investing in enabling technologies as opposed to investing in mainline solutions, because I see that there is a shift to investing in enabling technologies, and the big sexy investments are getting less attention, and people are actually digging under to really understand what are the scalable type of technologies that are required to make these fundamental changes. Your views?
It's both. So, I had the slide on decarbonization of electricity. It was sort of split down the middle. The IEA in their roadmap to net zero have about 50-50 scaling existing stuff and new stuff. So we're going to invest in both. I would say, as the emerging stuff becomes mature stuff, that opens up new business models around asset optimization, soft cost, etc. So, like PBKs, which is that design, helps software product developers design their projects. There wasn't a large market there 10 years ago for them, and there's a ton of examples like that where optimizing your project by an extra 2% is not going to move the needle when there's only a couple of gigawatts globally. But when there's hundreds of gigawatts globally installed, then all of a sudden enabling technologies actually have big markets to go after. So we're going to invest in both, but as things move out of the emerging tech bucket to where they're actually widely installed, that opens up new enabling things. And again, like Ross sort of touched on this, like one reason for hope is humanity, when we put our minds to things, we often solve problems. One of the most kind of infuriating or bemusing lines you often see in kind of Guardian articles bemoaning the trajectory of things is, along current trajectory, X, Y, Z will happen. We're going to be up to our eyes in plastic. All this resource is going to be gone. What happens consistently is that we observe what the bottlenecks are and someone removes them. So again, that kind of we're optimists, and the closer we get to the innovation space, the more optimistic we become. It's both, but as things scale, then it opens up opportunities for people to work on around the edges of those technologies.
It's worth probably being a little bit explicit there, Bela, as well, and saying, I mean, we're very much focused on, I'd say, venture and kind of innovation more broadly. I think it hits the enabling and the existing, but it's very much venture, not, infrastructure and kind of utility scale solar projects or anything of that. Rather, it's the technology that feeds into those projects.
Sure.
Thank you both. You can just unmute yourself if you have more questions. We still have 7 minutes to go. So please feel free to shoot your questions directly, or again, please use the chat field if you cannot unmute yourself.
If there's no immediate questions, maybe I can ask one to the audience and do a quick poll. I'd love to hear if anyone has invested either directly in companies within this space or in funds, just to kind of get a gauge on, where the kind of audience is in terms of that journey. If anyone's open to sharing, that is.
Maybe I'll let people, because a few people put questions into the chat. Maybe if people can respond to Ross's question in the chat, I can, or together we can hit Mark and Shravan's questions. So does the venture model fit the timelines with tech development? You have to be very cautious where you get on and off the train. Funding stuff which is at lab stage with venture dollars in the hope of getting them back within a 10-year fund horizon. It depends on the tech, probably not. Normally where we're investing is between seed and Series A. I say the funds that we're investing in. And usually that's the point where the science has been established and there's some sort of bench scale demonstration of the tech, and you're moving from really into engineering and productizing whatever the thing is. Again, I mentioned this, acquisition is going to be the route to exit from most of these companies. So that also means that valuation discipline around entry is pretty important, because an incumbent industrial is not going to pay whatever multiple for technology, because their CFO needs to be able to demonstrate some sort of payback period. So that there are definitely nuances around some of the hard tech stuff. And frankly, exits in this space, TBD. It's sort of, we've only really been applying ourselves to this for the last 3-4 years in earnest. So we're going to see over the course of the next 3, 4, 5 years what really is there. But the ones we've seen have mostly been acquisitions.
I think just to tag onto that as well, Bella, I think you touched on it earlier, but it's the understanding of the cap stack. So clearly pulling in venture dollars when it makes sense to have venture dollars, but there is a huge amount of non-dilutive capital out there, be it either grant finance or project finance or different forms of debt finance. So it's actually, one thing we spend a lot of time is understanding managers' understanding of that cap stack and seeing how they understand how to mobilize it and pull it in at different times as well.
Yeah. The next question on water. So water is a pretty niche area. It is extremely difficult to scale, even amongst hard tech. Water utilities are very conservative. I advise a group that does project finance for emerging climate tech, and one of my colleagues there has scaled water businesses and is very involved in that space. And it's a very small world, and it is getting more attention. It will definitely get more attention with place-specific issues. I saw someone here works in India. Obviously, India has huge challenges with groundwater depletion, etc. So water solutions are going to have to come to the fore more, particularly where patterns of rain, greater soil water evaporation and everything with climate change comes to the fore. So water is actually a big bucket in the adaptation end of things. It's still pretty niche. There are a handful of people that are specialized in it, such as Burnt Island Ventures, where my colleague is also a venture partner. But for the moment, the opportunity set from our vantage point is not massive. Ross, do you want to hit Mark's question on geographic spread?
Yeah, absolutely. So geographic spread, so it's going to be about 15 managers. It's going to be roughly 70 to 75% North America, which is where their HQ is, and the rest will be in Europe. The underlying probably something like 250 to 300 companies. We think that spread's going to look a little bit different, as quite a few of the North American managers are actually investing into Europe, and more so actually, especially with the policy, the kind of strong policy stance here. And also there's a little bit of a value arbitration as well. So we suspect the kind of underlying portfolio might be something in the region of 60-40, so North America, Europe. And then in terms of the kind of North-South collaboration, I mean, the kind of rollout of this technology, the way kind of personally, the way I envisage it is like the R&D is kind of subsidized for in the West and essentially rolled out in developing countries where they're, you know, ultimately they're still continuing to build big cities, major infrastructure and so on. So to use a lot of the kind of new materials and new technology when they do come to a point where they've kind of suppressed that green premium. And that's where we see huge advantages. There's one fund in our pipeline that we've done an extensive amount of work on, and that Beta is known for many, many years. That's actually one of their kind of USPs, where they have a huge amount of relationships in Asia. They are based in Europe. They take the technology from Europe and the US, and they actually kind of bring it into Asia and essentially accelerate the deployment that way. So it's an area of interest and an area that we think has a lot of interesting opportunities.
And the thing I'd say, so the deployment is key, because that's where the population growth and ultimately the energy demand growth and demand growth for stuff in general is going to come from. China uses in 2 years as much cement as the US has in the last 100. It's actually, it's crazy to contemplate. We would love to see more global South indigenous solutions come up. At the moment, it's pretty thin. One of the funds we're investing in actually does have some investments that either operate or were founded in broadly global South middle market countries, but outside of North America and Europe for sure. So we are seeing some of that starting to percolate through. We would love to see more. We're certainly alert to those opportunities. But yeah, for the moment, as Ross said, predominantly the innovation is happening in global North, Europe, North America.
Thank you very much, Bela. We are at the hour. I'm sorry. I know we could have gone on for a lot more, but need to close here. But again, for those, I saw that a few people joined us a bit later. So please feel free to connect with Ross and Bela. I'll be sharing the contact details, also the presentation, including this recording. We believe that we can't reach any of our goals if there is no collaboration. So please collaborate, connect with them, and make sure you share it also with your network if anyone is interested in learning more about this topic. And again, Ross and Bela, thank you so much for sharing your insights and the impactful work you're doing through Healing Capital, which is pretty impressive.
Thanks, Deborah.
Thank you, everyone, for joining today. It was such a pleasure to have you with us in the room, and I really look forward to having you at another IIFB. To keep you updated, we'll send you emails. You can check our website. We'll see everything there. Thank you, everyone, for joining, and I wish you a wonderful day ahead and look forward to staying connected.
Thanks everyone. Thanks everyone for joining. We appreciate you taking your time.
Thanks so much.
Thanks, guys. Thank you, Deborah.
Thank you. Bye.